Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Friday, October 21st, 2022. It is 9:47 Eastern Time. So I'm starting the video, and here's what I'm going to cover. Sounds like a lot, but I'm going to rip through these pretty quickly because most of these are updates, but I'm going to expand on a few things and share a few other comments that I think are relevant right now. Cover the equity markets, really sticking with my go-to trading proxy, the Nasdaq 100, or index, I should say. And start there. I think it's the most important index, number one, and it's also, the most conducive to trading, in my opinion. Gold, silver, U.S. dollar, and euro, because they all tie in together. Quick update on the natural gas setup, and then Treasury bonds. I want to do an update there as well. Sounds like a lot, but I'll go through there pretty quick. So starting out here on QQQ yesterday, the last update of the day I gave you, I told you we closed right on the line, but I favored a gap down, was leaning towards that, and we got it. We got a gap down. It was also a gap this morning to be shorted. I mean, geez, since last night, let's see, just, I'm told to trade actively on the 5 and 10 minute charts often. I was, after that last update, long, from after being short, went long, short, long again, 2 trades this morning, and I'm currently long right now, and I'll show you why, and that may change too by the time the video is over because we're still flirting with that level. But let me get down to the 60-minute charts. So there's a gap down. You can see this yellow line right here. There's a yellow line. There's a close yesterday. So we gapped down, back tested the gap, and then we're trading right on it now. So when you look at where we're at, we got the gap down, but then they ran it right back to this magnetic level. 269 is like a magnet right now for these candles. And let me get down to the 60-minute charts. Now, what I did mention is we have the 60-minute divergence right here. Hold on one sec. No, I'm sorry. There was a bearish PPO crossover. All right, I already went over that. I showed you. You can look and just see what happened each time we had crossover. So I may flip back to short here. We'll see today. It's a good weekend. Remember, even if you're a futures trader, you still have that overnight risk that you don't have on any other day of the week. So keep that in mind, and take your position size light is what I usually do, unless I have a very, very high degree of confidence where we're going to go on Monday. All right, so that's that, but let me show you again. There's nothing new to report here. We just continue to vacillate around 269. It's key support. We do have the bearish crossover, but we also, what's going to keep the markets guessing, and maybe more so in a holding pattern this week, would be the big market-leading FANG stocks next week. All those that hadn't reported, we pretty much have Tesla out. Tesla's really one of the, what I call the FANG E plus Ts. They report next week. That's Apple, Microsoft, Alphabet, the whole lot of them, Facebook. And then, of course, the following Wednesday, you have the big market-moving FOMC meeting, and I'm going to talk about that as well in this video. Short term, let's go down. Let's look at the futures. Okay, let me start here. I'm gonna get back to the 60-minute chart, and let me just again tell you where the money is right now. Last night, this is after the close, Bud Getney asked, hey, could you give a 60-minute or a chart of NQ? And so he didn't specify what time frame, so I posted my favorite, which is 60-minute time frame, saying, look, we're back testing. We had a divergent high recently, and that was the cause for this drift back here. Small divergent high. We came back, but we were back testing this trend line, and then I followed up after that. I noted a little divergence here, and then let me close this out. Followed up with a 10-minute chart and said, here's a trade idea. A little bullish falling wedge pattern right there. Beautiful little bullish falling wedge pattern. You have a nice clean downtrend line. Again, this is the micro trading, I call it, with a breakout to come on, a buy signal to come on a break of the wedge plus that 1107 support level. They came in together, targeting this downtrend line and this level right here. You had a reaction high, and then you had price resistance a hair above that. That was last night. Went on. Let's go down to the 10-minute chart, just show you how these things play out. There's the 10-minute chart. I'm going to tighten it up for you just to focus it on that level. And so this is it. This was that wedge. There was your breakout. The breakout occurred right into the 11, same 11,017 resistance I had. So what happened, you had an initial pullback reaction off that. Then you took both of them out right here. After the wedge, you just simply back tested the wedge. The breakout remained intact, no failure. Minor little back test to pop that level, and then went right up to this level here. And then those previous highs right there. So this is where I had modified, and oh no, that's it. I'm sorry, that was where my stop was set right below that. That was the trend line I was targeting. Sorry, sell limit order. Reverse that. But then this morning, and this is what has me long now. So there was a reversal trade to be made off that. And then this morning, we put in this even bigger divergent low right here. Remember, it's starting with this divergence, give us this little pop, but now an even bigger divergent low. And that's, usually the bigger the divergence, the bigger the rally. So this one has currently put us back right on that level. And based on this, not only this is again a 10-minute chart, but then you go here to that 60-minute chart, which is more significant. The longer time frames always carry a higher weighting in my opinion. And so we'll go to a 60-minute chart of NQ. And remember, we've been back testing. This is the same trend line. Figured we'd get another bounce. We broke out above it. Back test number 1, bounce. Back test number 2, this is where that 10-minute setup was. So that 10-minute setup was in conjunction. You couldn't see it on the 10-minute chart, but you had NQ at support here on the 60-minute chart at that very same time, and that was that tradable bounce to be had. And look, it also ran into that uptrend line was where it got rejected. So we're ping-ponging. Again, technical analysis works amazingly well, at least my style of it, during bear markets and periods of high volatility. And that is because the fundamental guys don't know their ass from the head in a hole in the wall. They don't know what to do because the fundamental landscape is changing so fast. So the Warren Buffetts of the world, how do you figure the valuation for Coca-Cola or FedEx or any of these companies when the macro landscape is changing so rapidly? Everything is now largely, but not exclusively, dependent on what the Fed does. And so that's why technical analysis tends to shine. You get once the market's flooded with quantitative easing back like after COVID, and there's just so much money sloshing around, the fundamental backdrop is so bullish, and then there's so much liquidity, and algos are just buying dip after dip after dip. That this style of trading isn't as conducive. So right now it is, and again, this is where the opportunities lie. So we're just really, this is just swing trading like we do on the daily and weekly time frames, but on a much smaller scale. And it might not be a lot. You get every 1% move in the Nasdaq 100 futures is about $2,000 in profit. So if you catch just a 1% or a 0.75% run, it doesn't take many contracts, even a single contract, if that's all you're trading, it's going to usually make it worth your while, and they all don't pan out, and that's what stops are for, and stick to your trading plan. All right, so where we're at, let's get back to that. Here we are. This is at 11 on this time frame, the 60-minute. We've been also vacillating or oscillating, if you want to call it that, more so vacillation around this 11,100. You have the downtrend line, and again, like I just pointed out, you have a positive divergence right now. So cross currents, if you will. Yes, last night again I said, look, we just had that bearish cross on the 60-minute PPO. But on the flip side, they're holding this 269 level like a magnet, and so here's the takeaway. I'm not in swing trading mode right now. I'm in more active trading mode. I'm going to take these 10-minute charts and 60-minute charts and decide whether to be long or short for that minute, for that hour, maybe a couple days. Right now I see a whipsaw down through there. I expected the gap down. We got the gap down, but then for the reasons I just mentioned, I bought the gap down. And now we're recovering it. So let me stick to the order I told you, and we'll move on here. So right now, just holding tight. I'm going to let these run for a while. I don't even have any targets. Why? Because we just put in a divergent low on the 60-minute chart. 60-minute divergent lows are usually good for multi-percentage gains. In a bear market, single digits usually. Quite often, the biggest rallies that we've had, all the double-digit bear market rallies this year have been off the divergent lows as well, but usually bigger ones than that. So right now, let's just say this should carry us up. Ideally, let me see if there's a downtrend line to add here as well. We could maybe do that. Put that one in there. Could maybe carry us up here, but today, Friday, anything goes. But remember, whatever happens by the end of the day, I'll be reducing position size to tuck in for the weekend. So right now, let me just say I'm sitting long, and I'll at least think we'll carry up back up here again to 11,350. But we've already hit it several times, so we could pop it. Here's why I'm going to get to bonds in a second, and that's playing into this as well. My whole thing of where I think we're going, but let me stick to the order I promised. Gold, there it is. This is the setup I gave you earlier this week, and we never broke out. A setup is a setup. There's two type of trade ideas I share: actionable and a setup. A trade setup is when you're within a bullish or a bearish chart pattern, and you're waiting for a buy signal or a sell signal, meaning a breakout of that pattern. And so the last time we were either here or here, I can't remember, but we didn't take it out. And it was also conditional at the time that the euro had to also break out. And so we didn't get those. We had one or the other, but not both. And now we do have gold popping. It's not by a lot, and yes, it's a 60-minute candle, so anything could happen. It can get smacked down, but I continue to see the euro firm up. I'll get to that in 1 second. And this 60-minute candle looks ready to print here any minute now, 2 minutes. Remember the first, well, this is futures. To be honest, I know that on the stock market, ETFs and equities, the first candle is only 30 minutes because there's 6.5 hours in a trading day. So you have that 9:30 open to 10 prints the first 60-minute candle. Then they're all on the hour after that. Either way, this looks pretty good. It's pretty impulsive. And look at that divergence. This to me is a bullish falling wedge that is ready to pop. It's like a woman that's 9.5 months pregnant. That baby's coming. And this wedge is just ripe to pop. You have a double bottom right there. Balls in the bulls courts right now to pick it up and run on gold. So that's one of my favorite picks right now. And boom, it's already breaking out. GLD obviously is the ETF where the miners should run as well. But let's look at the euro real quick. Okay, I'm not going to spend a lot of time here because I got this chart out to you this morning along with that same one of gold. And I'll just focus on that 60-minute time frame for now. I have been covering gold lately, and I showed you what needs to happen on the daily to make it even a longer-term buy signal. Right now, here, let me just, make it clear. At this point in time, we have major resistance on GLD on the daily chart. Back here, if we back test, this is a big level, 158. I think we're going to recover it, but that's going to be your first big resistance. So if you're just a swing trading right now and you just think there's a little move to be made in gold, then you're looking at probably about a 4% rally. Remember, silver, you're usually going to get more bang for your buck. You'll probably get twice that on silver if you trade it. But let me go back to that 60-minute chart of your RUSD, which is a big driver because gold trades inversely to the dollar. And that is, I'm not going to call it an immutable relationship because there are times where supply-demand dynamics can overwhelm the impact of a rising or falling dollar. But the most simplistic way to explain it is gold. The gold we're trading here is priced in U.S. dollars. If you buy GLD or gold futures, GC, and a lot of places around the world, it's in U.S. dollars. Not everywhere, but when you're trading gold in U.S. dollars, a falling dollar is going to cause the price of gold to go up. A rising dollar will cause it to go down because if you freeze supply and demand, it takes more dollars to buy an ounce of gold when the dollar is weak or falling, and fewer dollars to buy when it goes up. And that's why that component of the relationship for simple mathematics or arithmetic is immutable, but the supply and demand part can vary. You can have a falling dollar and gold should be going up, but then there's a big seller of gold, central bank or something like that. I'm going to add a level. Sorry, I'm just noticed as I'm doing this, there's one little level right there to contend with. But the takeaway here is this is that symmetrical triangle pattern I gave you earlier. And so if that pops, that's going to be big. And then I think really there's that BOD, what I call BOD, benefit of the doubt line I just added. That's about 98,633, 0.098633. Currency's trading pips, which is rounded out to the fifth decimal. That should really send the euro rocking right there, I think. And what I'm seeing, and the reason I favor an upside break, symmetrical triangle patterns are inherently neutral. It's just consolidation. They can certainly break either way, but look at what we've had. I mentioned this morning. we've had a series of higher lows. 1, 2, 3, each of those being divergent lows, positive divergence, 1, 2, 3. But we don't have a confirmed uptrend yet, because since that low here was our first reaction high. So once, if and when we take that reaction high out, then we're going to have the early makings of a new uptrend in the euro, and that should be quite bullish for gold. It should be bullish for Treasury bonds, I believe, because they've been moving inversely. And I'm going to get to Treasury in a second. So there's the one of my top picks right now. Like I said, we'd have a breakout on gold. It's not an all-in moment yet, but if the euro takes this level out, especially that 09633 98633 level, that should help add fuel to the rally for gold and help to confirm that breakout I told you that is happening now. But again, you also see you broke out, but you're at the first resistance. It's about 1649.50 or so. We'll call it 1649 or 1650. Take that out, and if the euro can break out, then that should be nice for gold. Okay, enough on gold. Take it, don't take it, up to you. I like to spread my bets, and I also like to just trade things sometimes just purely on their own technicals, regardless of what else is going on. Natural gas is still not broken out of that trend line. This is a setup I gave you yesterday, hourly chart. Here, these futures are going to roll soon to the next contract. I'll update that as soon as possible. December's are going to look the same. You have to take out this downtrend line here. We have gold natural gas at pretty much at long-term support, hair above it now, but we still have the divergences as of now, clinging by the skin of their teeth, at least here on the RSI. You could go down just a hair more on the PPO. So if we can reverse here and pop that trend line, that's going to be your buy signal, and that would carry us up. I really, there's little micro levels here I could give you, but I think we'd run up at least here to 6,312. And if we do that, again, the case was made that nat gas is at a long-term support level. So I'm looking at this one as a potential trend trade where it could go up quite a bit more. Right now, still waiting for that trend line to pop. All right, that brings us up to treasuries, and then I'll wrap this video up. Treasury bonds, let's look at yields. TYX yields hitting all-time high, or not all-time, but multi-year highs. Let's go back and see where last time the 30-year Treasury bond was yielding this. Let's just play this game real quick, because this speaks into my Fed pivot thing I'm going to get to in a second. But you can see here, that was that shelf of support back, I already covered this recently, all the way back 2003, 2005, 2007, really right up to the financial crisis. This was really a floor in Treasury bond rates, the 30-year bond. And you can go back as long as you want after that. Remember, we were in a secular bear market in interest rates since the early 80s. Think Jimmy Carter leaving office, Reagan coming in, that's when rates peaked, hyperinflation back then, and nothing but lower rates. And then the Fed just started getting all wonky and Fed gone wild. When 2008 hit, they figured, oh, well, we did it there and the world didn't collapse. We can print money all we want and get bigger and bigger and bigger. And they kept initiating rounds of quantitative easing, bringing rates down to artificially low levels. And then finally they went all out nuclear because they figured, why not? As much as we did in 2008, why not just do more? And they did that, and now the unintended consequences. You print too much money, this is economics 101, then you're going to cause inflation sooner than later. And now they got it. They're trying to reel it in. But the most important part is we've taken out previous reaction highs. This is the making of a new uptrend. So I do believe we're in a new secular, most likely begin a new secular bull market in interest rates, which is going to be bearish for bond prices. However, nothing goes straight up forever. This is an unsustainable advance. I've said that before, and I maintain it, and I feel as strong as anything about this. Parabolic trends do not end well. You're going to see, I believe, an explosive, again, I'll use the word explosive rally in bond prices. It hasn't happened yet, but with every tick higher, I think it's even going to happen more. The rally would be more explosive. Why? Randy, as that goes, you're wrong, you're digging yourself in the hole. No, I'm continuing to scale into bonds, and I'm still waiting for the all-in buy signals, which I'll get to in a second. But when you earn a parabolic advance, just think of the dot-com bubble back in 2000. For those of you old enough to remember or young enough to have studied history, if you're into this stuff, Uh, I was certainly around then. I was working as a stockbroker back then. I remember it very well. This is a parabolic advance. Parabolic advances do not end well. The Nasdaq Composite had a drop, bear market of about almost 80%. That's just right there. You grab that high, measure it, go check it on yourself. 80% drop, almost 78% or so, because that's what happens when any security. I've seen it time and time again, whether it's crude oil or natural gas or soybeans or an individual stock. This is what happens when things go parabolic. I've never seen a parabolic advance that I can recall, and then you just consolidated and then went on with a normal trend. They almost always end that way, and that's what I believe is going to happen in treasuries, but not to that large an extent. I don't think so. We'll see. I always say the charts are dynamic, and so is my analysis. I am looking for, we're at that major resistance right now, a brief overshoot. This is a weekly chart we're on right now. We'll see how we close the day. I think we'll get a reversal today, probably park right about on there, give or take. And then ultimately, here's the, well, that's, remember we went parabolic, but I think we'll come back in. And here, let me give you one more line. I'm going to color these up for you. This would be my minimum target right here. And this is the yield. You don't trade the yield, you trade the actual bonds. In this case, it would be TLT for the ETF or ZB for your futures. But that would be a minimum drop in yields. And then you go here down to the daily chart. And so this is the trend line I'm looking at. This is my near term and most significant trend line now. So many clean reactions. This thing is in autopilot mode. Yields are walking up, and so this seems like a blow off top. And you see when you already, we've been moving up with steeper and steeper trend lines, but this one only has a few reactions. It's valid, and I think we're going to come back to that. That would be a swing target there. So that previous reaction high, this uptrend line, but this now you can see this, we're going parabolic off this trend line. And Fed's coming up Wednesday after next, and I believe we're going to get a pivot. Not a pivot where they all of a sudden start cutting rates or go dovish, just a backing off. And I think we're probably, who knows what we're going to get, but my guess is we're going to get 50, not 75 like the market's talking about. We'll get 50, and they're going to have some kind of verbiage where they come out and say they're going to pause for a while and assess that they've noticed long-term rates coming up, the real estate market slowing down, everything, blah, blah, blah. Maybe even hold off or cut back a little bit on the quantitative tightening. And any slight pivot sets up the move for an explosive rally. That's just because not so much that even if they just pivot in rhetoric, it's not so much about what they do. It's just the fact this is a lopsided, one-sided trade, and I love being on one-sided trades, the right side of that. And you get a crowded rush for the exits. All those that are short Treasury bonds will be covering. Institutions are going to buy. At some point, they're going to realize, hey, yeah, we had a big surge of inflation. It's abating, and that's the other thing. I'm seeing oil prices come down, natural gas prices come down. That's an abatement of inflation. I'm seeing home prices are coming down. That's being documented. Pretty sharp reversal, especially on home sales in the housing markets. We're approaching 7% on the mortgages. So at some point, institutions are going to look and say, well, the world's falling apart. Look what's going on in Britain. Where's the next shoe to drop? And they're going to start flocking into the safety of U.S. Treasuries. And they're also going to say, you know what? And this is probably decent yield, even though it's under the current rate of inflation. It's probably about where inflation's going to moderate to over the next few months, because I think the Fed's overshot here. So still loving this one, but it's not an all-in moment till you get to take out this trend line. That would be at that point all in heavy. I mean, not at that whole portfolio, but heavy add to it. That's TYX. That's the 30-year. But let me talk to you about the 10-year TNX. You want to see both these trend lines break. There it is, beautiful trend line in TNX. Still have, look at this. Well, there's your divergence line. I'm going to take this one away right now, and I'm just going to focus on this small divergence right here. And there you go. That's we'll just move it like this. You can leave that other line there if you want, but that's our current divergence, and that would be your sell signal there. I think I already have an alert. I'll have another one. Boom, and then probably come down pretty sharply here, and then ultimately on this cycle, once this pops, I think we'll come all the way back to this one here. That'd be a nice trade. That would send right here. There's your target, the trend line, and that 2660 level. Again, how to trade it. ZN or your 10-year Treasury bond futures, and IEF is the 10-year Treasury bond ETF. And so you can just track this, or I'll give you the comparable targets on those later. I just wanted to focus on the yields because that's a pure, clean chart without any distortion like sometimes you get on ETFs. And then or FVX, I'm sorry, this is the 5-year yield, same thing. So what I'm noticing lately is I'm noticing a outperformance on the short term, and this is what I expect. The market is making a pivot already. They are seeing, I believe, whether they see what I see or not, this current rate of ascent in Treasury bond yields, as well as the U.S. dollar, is unsustainable. And I've been saying it for a while, but things already have broken. When have you ever seen in history? This is the shortest British Prime Minister term in history, 7 weeks, and we have a resignation already of the British PM because didn't know what to do. They can't figure out up from down. Do big tax cuts? No, we can't do big tax cuts because it's going to balloon our deficit. Going in and making emergency measures to stem up the gilt market over there, and their pension funds, at risk of blowing up. Those are the cracks. They're fissures now, and so again, because of this, the Fed cannot continue to push. They're going to cow down. I feel as strong as that as I've ever felt on anything. And when they do, these are going to break, and you're going to see a sharp down. And we're talking a week and a half from now. And I think the market's probably going to price that in advance. So this is one of my favorite trade ideas right now. And again, you can trade it via the ETFs. I gave you a chart. The last one I gave you was ZF, because this is going to reflect shorter term rates closer. It's the 5-year. And you can go and see there's a nice little mini wedge right there, a minor downtrend line with your primary trend line. And so and then pretty big resistance right there. So yep, the 105, 151 is a nice price resistance. So this is, once we get that, you're going to have a recovery. You're going to have a recovery back above that support. So you'll have a little bear trap. You're going to have this minor wedge breakout. Should send us ripping right up to that 107.060, and then that's the all she wrote all-in moment right there for short term. And this can only happen if the market believes the Fed's pivoting, whether it happens before next Wednesday, which I believe it will, or after next Wednesday. If I'm wrong, look, it's Armageddon. I'm gonna, I'll be, if that happens at the time, like I said, I'm back and forth on stocks. I told you I'm long at the moment, but up until recently, my hedge has been short equities and long treasuries, and as an indirect hedge. And the treasuries fell less than the stock market was falling. Stocks tend to fall more, but lately I've kind of moved over and went into active trading mode, like I told you. So, and I'm just waiting to add to these. So again, top pick right there. And you can trade it via, if you don't do futures, you can do IEI as your targets around the 5-year range on treasuries. And there's your minimum target right up here, 108.223, maybe 109.19. We'll see. Same thing on let me find you the 10-year, looks similar. We just continue to diverge, bigger divergence forming. That's all. And there's your primary trend line. That's still, we haven't taken that out yet. So if and when that goes, which I highly suspect it will, and we're starting to see a hook today, these guys are moving up pretty nice. Especially, again, that's what I'm watching of the 5-year. That's where I think that you're going to see the most movement. They also have less risk. The 5-year bond is less volatile inherently than the 10-year, which is less volatile than the 30-year because of the extra. And see, we're already up 0.4% right now in the 5-year, and the 30-year is down 0.91%. So that's what I'm seeing. These short-term rates are moving up. The market is, at least as of today, in the last couple days. It's not just today only. The market is starting to, I've seen outperformance on the 5-year versus the 30-year. And but the 30-year will explode because we need to get those sell signals that I talked about before, because the setup is certainly there. We just continue to diverge, 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 holding on to that divergence. Go back here, take that line, go like this. And if they can pivot soon, you're going to keep this big positive divergence in place. This is only a 60-minute chart. And minimum, come back up here to the primary uptrend line. Let me show you on a 6-month. There it is. There's your primary uptrend line. And this looks to me like a capitulation. And, when you have a downtrend and all of a sudden you move down sharply, let me throw up volume, see what the volume, there it is. So you want to see, it's called a selling climax. It's capitulation. When something's been in a downtrend, walking way down, and all of a sudden it just really falls off and drops on really sharply. If you see that on a big volume spike, that's what we call a selling climax. It's where the last of the weak-handed longs just puke it up. They can't take it anymore. They throw in the towel. They get stopped out, or they just pull the trigger and sell. It shakes out that pool, if you will, of weak-handed holders. And so whoever hasn't been shaken out, once you get the reversal, if they didn't get shaken out today, like me, they're going to then not going to get shaken out once they see a reversal and this thing starts heading up. And then you have at that point new buyers coming in that are fresh, and they don't have the ingrained losses of those that capitulated. So that's how a selling climax works. At least that's always been my interpretation of how it works. You read up on these, they just tell you what to look for, and that's it. That's a signature of that. So there it is, guys. Still, if I liked bonds a week or 2 weeks ago or 3 weeks ago, I love bonds right now, and we'll love them a lot more if and when those trend lines that I gave you earlier are taken out. And if nothing else, a fundamental reason. I know the headwinds are quantitative tightening, but I did read that the Fed had accelerated their QT program. What is it? One of the firms, I think UBS, is now calling, they expect that quantitative tightening may end earlier than expected now, sometime in March or early next year. I think the end of the first quarter. Remember, the markets always look ahead, and that's because the Fed had accelerated the amount that they were doing. So they kind of front-end loaded their quantitative tightening already to an extent. And again, whether they certainly haven't finished the runoff that they plan to, but like I said, they will pivot. As much as Powell is just rolling around losing sleep at night right now because he looks like a fool for the last year or so, dismissing inflation, why it was clearly apparent to everybody, and every metric inflation was ripping since COVID, and he was dismissive, did his little 180 way too late, behind the curve, talking tough now, but he's going to have to pivot again, or the whole financial system breaks. The Fed's dual mandate is maximum employment and price stability. Well, guess what? Inflation, yes, works against price stability when you have, but it's something that's a little more constant. What's not price stability is a crash in the stock market, a failure of a major financial institution, a failure of a major G7 nations bonds breaking the UK gilts or other things like that. That is to me much bigger in price instability, and therefore, as such, what I'm trying to say is the Fed cannot continue to let long-term and short-term interest rates continue at the ascent that they've been. At best case, it's going to have to level off soon, or the whole system will break. And so I have pretty good degree of confidence. Very little confidence on the Fed, but pretty good degree of confidence that we'll at least see leveling off here in rates soon, if not a bit of a pullback, little correction in rates, which would be a rally in bonds. All right, and that's it. Well, the stock market's going to do its thing, grind around for the next week or two, like I told you, with the big fangs on deck, and then the Fed meeting right after that. So I wish I could say it was all clear signal at the end of next week, but the Fed meeting is probably going to be even bigger than what Apple and Amazon and Microsoft report. All right, that's it. And let me get the video out to you guys, and we'll see if I see anything else that stands out. I'll let you know. This has been Randy Finney with Right Side of the Chart. Have a great day.